Hi, good afternoon. Thanks for your time and wishing you and your team a very happy Diwali. Thanks for joining us today. And Deepak, the kind of move that we've seen, first of all, on large caps, something like Reliance, HDFC Bank has been good, banking names have been good with their earnings, and IT also has not been all that bad. Do you believe the next phase of the market could be led ahead by the larger names, the large caps? Is that where the market should be focusing?
Hi, good afternoon, and of course, wish you, your team, and all your viewers a very, very happy Diwali.
Thank you.
Uh, so I'll quickly dwell on the sectors. The results that have come in so far are encouraging to a certain extent, especially in the financials. I think it's a little early to call because we still have a lot of results remaining, but it looks like the September quarter has been quite okay in terms of both sales growth and a lot more in terms of profit growth. We're seeing more than 15% median earnings growth in all the companies that have reported this far, and that's quite a good start actually. So hopefully the bad results are not towards the end of the quarter. But in general, I'm feeling a little more encouraged about this because we thought the GST impact will actually start to flow in only in the October quarter. So the better results should start flowing in at least from the consumption names only in the October to December quarter. Overall, large caps will benefit if the foreign investor selling pressure starts to reduce, or at least there is some alternative, maybe buying pressure as well, because much of the FI concentration is in the larger caps. So their selling perhaps keeps the Nifty and the larger caps subdued in comparison with the mid and small caps. So I would say that perhaps that is one flow level. But earnings wise, I'm seeing in fact better results from mid and small caps. So we're looking at economic growth. I think we should be focusing on mid and small caps, but currently smaller flows. We're seeing some incremental relief coming in for the large caps. So hopefully the Nifty will do well in the next year. I'm biased because we are naturally long in our assumptions and in our positions.
Deepak, hi. This is Harsha. It's been a while since we spoke. Deepak, give us a sense. Where's the portfolio tilt towards? It'll likely be towards pockets where there is decent value along with a good growth tailwind on the profitability. So give us a sense on where those pockets are, because H2 likely is going to be a stronger year where growth in profitability is concerned.
Yeah, I think early names that we're starting to see in portfolios. We have a quantitatively run portfolio, so a lot of it depends on the data that comes in. And the data is coming in slowly as companies announce results, but we're seeing some attention paid towards the healthcare names. I think part of it was news driven also because when the government increased the rates for CGHS, there was a push. But in general, I think healthcare in India is under penetrated and in a way undervalued also for the longer term. Of course, in some names valuations are still rich, but I feel that overall there's a lot of growth coming here. There is possibly some growth that will come towards consumer durables. We're seeing that in auto. The auto names are doing very well, both in terms of reported numbers and in terms of potential for growth because of the GST changes. Some financials, larger banks, larger NBFCs seem to be doing reasonably well. Some of the gold names are also doing reasonably well. So I think those are part of our portfolios. I'm just giving you the mix overall. We're seeing very little FMCG here right now, but early names have started to pop up. And then we want to wait for results to come in before we make an estimation. There is lagging. There's not much as much interest in IT perhaps right now, or in some of the textile names because they have been hit by the export issues with tariffs to the US. But by and large, a lot of the other sectors, the industrials definitely are strongly represented, and we're likely to see some incrementally big profit numbers, in the next 6 months, maybe the full financial year, because I think order flows will be have been quite good for them, and then they will start to show these they will start to show this in the results in this year and the next year.
Okay, so Deepak, those are some sectors that you're liking, but in the previous answer, you made a very interesting point that the large caps can only move if FII buying comes back. Deepak, what in your view will take for FII buying to come back, because we've been largely underperforming and some revival is being seen in the markets now. It's early to say, but the earnings have also looked like they're starting to improve, at least compared to the previous quarter. What is the one trigger that the FIIs could perhaps be waiting for to make them start looking at India in a more attractive manner again?
So I think by and large, it's a cyclical thing for FIs. They kind of exit when they find either valuations or geopolitical issues a problem. Those things have been a problem for the last year or so, both of them in different ways. I think once those issues die down, we will see some change in sentiment of some of the FIs. We're less and less FI dependent going forward. So I think the overall market does not have major impact of FIs either selling or otherwise. But some of the larger caps, especially in the financials, you see the names have been overrepresented in FI books. So you see that they tend to lag when there's a lot of FII selling. I don't think we need FII buying to come back. We just need FII selling to slow down. And perhaps some of that will be because of exhaustion, because they've sold quite a bit already. And then maybe they will be like, okay, we want to, slow it down or keep our allocations to where it is. And that's all that's required really, because domestic investors are now more than 2 times the amount of FII outflows and growing at a reasonable rate. And that will perhaps cause some kind of a fillip onto some of the larger caps, which have become reasonably valued. Earnings, I think we're going to take 2 more quarters to reflect that completely in numbers, and we're going to see some of that reduce their price to earnings ratios to a more reasonable level, at least at current nifty levels at least. So we're going to have to see some of that economic growth kind of percolate down into net profit numbers for the full year before we see a major change in FII sentiment. Perhaps that will only come next year, and it'll probably coincide with either a trade deal or some reduction of geopolitical hostilities, whatever it is supposed to be happening with America and China, that should reach some kind of a conclusion as well. I think that these are the impactful points where I think FIs will reallocate to India. But like I said, there is interest. We've seen big deals coming from even an Emirates bank buying into an Indian bank. We're saying, or I think RBL, that deal was going on. That's a fairly large number for a single bank deal, and there is perhaps that interest will also starting to emerge on the M&A front. That might also change in terms of sentiment going forward.
Was about what could lead the rally over the next 12 months. Deepak, the one big mover in trade today, in particular, on the back of all of the numbers that came over the weekend, was outside of a Reliance, some of the banks which have done extremely well. RBL in particular, we did speak about, but some of the smaller banks, they've all surprised where margins are concerned. They've all given positive commentary where credit costs are concerned. And all of these have the ability, or they've demonstrated the ability in the past, to grow at 20% plus for 2, 3, 4 years. Could we see that happening as mid-cap banking? Can it grow at 20% or maybe 15 to 20% also over the next 3 years sustainably without having concerns on asset quality? Do you believe it can do that? Because if that is the case, you could well see a significant re-rating in some of these prices.
Yeah, I think there is no problem for some of the smaller banks to grow, because I think they will eat into larger bank market shares as they adopt more digital. In fact, a lot of the smaller banks are far more digitally aware than some of the larger ones. And as it increasingly becomes obvious that banking is more commoditized, so there's no advantage to being with a large bank than it is to be with a small bank. I think some of these smaller banks will just get an upper hand in terms of their digital capabilities with comparatively slower private and public sector banks. There are lots of public sector banks that aren't exactly as easily engaged as in the digital formats as perhaps their smaller private sector mid-cap banks themselves. And there is a focus towards both secured and now unsecured loan growth as well, as long as parameters are well defined. This may put a dent into asset quality at a later point, but that's a natural thing. You do get if banks are well capitalized, they can handle asset quality equations well if they grow in a proper way. So 20% is not too big. Even a bank like HDFC Bank grew at 30% a year for nearly 10 years. But in a low inflation environment, it is more difficult to grow at the 20-25% because your natural growth is with interest rates being less. When interest rates are 9 or 10% on a repo, you're lending at 14 or 15%. So you get natural refinancing growth of 15%. You have to grow an additional maybe 5 or 10% more maximum. And then, you're growing at 25 to 30%. Now, if you have to grow at 20% and your natural loan growth is only about 8 or 9%, you have to bring in 10 to 11% growth, and that will largely come on the back of a lower base. That's what the smaller banks have, and they can venture into territories which were difficult to go into earlier, where, for instance, in Forex or in some of the elements around bonds and, not just from the treasury, but also for customers. They can do a whole lot of other things. A lot of banks focus on certain sectors, and as they grow to a certain size, then they can go into others. Some are only secured loan focused, some do not have that much interest in gold loans initially, some have only unsecured loan exposure. So they have to expand into others. Whichever areas they're concentrated on earlier have to go into the other sector. So they have the ability to grow. Now we'll have to see about delivery, because some banks choose the wrong path and then get into really bad asset quality equations and don't have the capital to back themselves up. Now we're seeing very, very good, CRARs across the board. So a lot of them are very, very strong capital wise. And there is an attraction of foreign capital that wants to recapitalize banks by taking up equity ownership as well. So that will also help them raise more capital as they grow and strengthen their balance sheet. So I think some of the private sector banks, mid-cap banks especially, can surprise us. And I think they will win market share from the smaller NBFCs and from the weaker banks in terms of digital exposure going forward. And I think we'll see a lot more interest in for SME and secured loans in the next year.
It's interesting the point that you make about market share. The smaller guy is eating away at the market share of the bigger ones. And I can't help but ask you if that's a trend you see on the retail front as well. You have a lot of these value fashion brands now. They're coming into the listed territory. Same is the case with quick commerce. Where do you think the older marquee players like a D-Mart or a Trent or any big box retail could stand, given that we have so many new players coming into the field now?
I think the game has many types of players. So, for instance, if you get retail brands in, the DMarts may still be a distribution point for them. So they might still, benefit alongside some new brands that are coming in. But if the new format stores or dark stores or whatever have you, I think the larger players need to invest in their infrastructure to be able to take advantage of the new logistics plays that seem to be coming along. Especially when these funded, unlisted players have some pressure to show profits. The minute a sector starts to show some profitability, you can bet that people who are in the listed space, who don't really want to go after deeply unprofitable businesses initially, will be able to put some of their infrastructure to work, whether it's a Reliance or a D-Mart or some of the other formats of retail, which have largely shied away because they don't want to lose too much money. But when the unit economics start to work out, you can see that the players may actually grow sales, but their margins will likely come down, mostly because the profits are spread across more players, and all of them have the digital capabilities to kind of come in and take advantage of the increased logistics footprint that some of the small players have built up for them. So they will, I think, there will be a point at which this industry will grow, but no individual player may take a lion share. So giving an extremely high valuation to these players is dangerous, because profit margins and growth may not be great at a per player level. It may be great at an industry level, just that there are more players coming. I'd say the same thing even of FMCG, when the brands get diluted, and it's so much more easy to now create a new brand and get into customer eyes, because your distribution points are the internet, and a lot of these new age products that can bring products to people's houses. And at the same time, the internet is also giving you visibility, whether it is Instagram or Twitter or whatever you have, in terms of getting more visibility of a new format product. So I think the problem here is the sector will grow, but maybe the individual players, um, they shouldn't be too overvalued, because it's difficult to make money in a very highly competitive, even though if it's growing market.
And Deepak, last question. IT, would that at all find favor at this point?
Specialized IT, I think, still will have. There's some players
Right.
who are focused on electric vehicles and so on. I think there is something there, because you have the ability to kind of in-source a lot of work into India without having to worry about all these H1B issues and so on. But by and large, I say, until there is a lack or reduction of animosity in the US laws, especially for US focused players, we don't expect growth to be that much, and we expect a lot of influx of sudden big bad news. So some customers slowing down their contracts, some customers rerouting their contracts, and so on, simply because the current environment in the US is not to make a large amount of greater investment in growth beyond this AI phenomenon that's currently over there. But eventually, I think a lot of this, once the dust settles, a lot of work will come back into India. It will come back outsourced to make more work happen in India, because moving people across is going to be more difficult. And eventually, there will be profit margins that are even larger than what they are currently, simply because more work is outsourced. You have these companies have to make their investments in building a lot of the knowledge bases in-house, even in the AI world. And I think they might make larger money because they'll need less people to do it. Not great for the job market, but I think good for the IT companies as they are.
Kunal, how do you view IT in terms of charts? Because that 1% move today, just trying to understand whether anything moves significantly with regard to your view on IT.
So it could be a contra bet, but the time frame I think has to be much higher. I don't see these stocks getting into that zone, sweet zone, like how the banking stocks are or the financial stocks are. They could be very good price-wise buy at current levels. Maybe these stocks may consolidate, not fall, from current levels. But for these stocks to provide those stellar returns, I think without that news flow or even surrounding the stock price, it's going to be difficult. You might have few of the IT names, like for example, Persistent. We were discussing this, I think, last couple of weeks. That stock would probably be one of the outliers in the entire IT or the mid-cap IT space. You might have one of the other names like Coforge, which can do pretty well for itself. But then most of the IT stocks, they would probably be at a price-wise a very good buy, but momentum-wise or in terms of short-term trading-wise, I would still be more of a wait and watch.
Sneh, HUL numbers expected 23rd October.
Oh, yes.
What's in store for consumption before we take it across and ask Deepak for a view on consumption?
Well, we're going to be off for 2 days, but earnings are now going to stop, because the day we come back, you have HUL from the Nifty group of stocks coming out with its numbers. Muted set of earnings is what we're expecting this time around.
Sure.
Much unlike Nestle, because, remember for Nestle, we were expecting a decent set of numbers, and HUL, for the first time ever this quarter, they came out with their quarterly update, wherein they flagged the caution from the GST rationalization and the impact that it has had on their inventory, on their sales. They've mentioned it's a one-off, but yes, they have flagged off some slowdown. And in light of that, consolidated revenue, we're seeing around 16,000 odd crore rupees, which is up at best 0.5% or 1% on a year-on-year basis. Not much to see there. EBITDA has also seen a 3,592 crores, which is a solid 5.5% knock from where it was last year. Net profit also, we're expecting to see it either flat or down perhaps 1% at around 2570. Margins are expected to be in pressure at 22.4% compared to 23.8%. But then again, remember 2 quarters ago the management had guided for 22 to 23%, that range for margins, and this sits well over there, so not much to worry about. But yes, on a year-on-year basis it is a cut. Underlying volume growth is seen between 2 and 3%, absolutely flat compared to last time as well, so we'll see what happens over here. Low single digit underlying pricing growth is seen of about 1%. Again, nothing exciting over here. But remember, HUL had taken price cuts in tea and home care, and they had taken a price hike in the skincare segment. So how these segments, be it home care, beauty, personal care or food, how they perform is anybody's guess. Beauty and well-being is expected to be hampered by personal care. It's expected to go down by 4%. Home care and food are expected to do decently okay. So when the numbers do come out, this segmental performance is going to be important to monitor. Their commentary on GST, for how long they think this overhang might persist on their channel, is going to be important to watch out for. Margin guidance revision, if at all they do something, is going to be important. Raw material inflation as well as demand from urban versus rural areas, that is going to be very important to watch out for. So yes, numbers from HUL on Thursday, the only nifty company to come out with its numbers once we come back from this 2-day break, and yes, muted set of numbers expected, just in line with what they had indicated in their quarter 2 update. So that's the take on HUL. I believe Deepak is still with us. Deepak, your take on some of these consumer staples. Nestle has been a very positive surprise, but then again, HUL, we're expecting to see some muted numbers. How should one infer the growth from the consumer staple segment this time around, because the GST overhang could be here for a couple of quarters?
To be fair, I don't particularly like them on a fundamental basis because if you think about their growth in the last maybe even 10 years, they're talking about 10 to 15% growth. They're valued at 40 to 50 times earnings. I mean, I understand high ROEs and all that, but honestly, growing at 15%, you can't justify these 60, 50, 60 times multiples. And I believe in the long term, it is not going to be such a great thing. It may be useful as short-term plays at different points, but not very exciting. There will be other plays in the consumer. Like I said, the brands are also they're getting competition from different types of brands, and all of those will eat into their market share at some point, and mind share as well. So I would say not very bullish on these stocks long term. I haven't been for the last 3 or 4 years, and you haven't seen meaningful growth from them in a stock price basis. Their P's have come down from the 80, 90, 100 times to maybe even the 50, 60 times. I still think they're extremely overvalued. So while they may grow a little bit, the GST thing won't impact them too much because by and large, they try to keep the prices the same, even if their input costs change by increasing grammage, if their input costs fell down. So a lot of the FMCG names are not going to report great numbers, even in the quarter going forward, because of an increase in consumption. I think the durables will do better rather than the staples. So not very keen on this
right. Deepak, then how do you play consumption? Very quickly.
Durables, I think that's the way the thing is. People will buy more fridges, TVs, cars, things which have a really visible impact of a downward GST play and are also long-term consumption goods, not something that's just fast-moving. Competition here is relatively lesser also, but it's also that we're growing this sector in a tremendous place, both from domestic manufacturing, the ability to introduce more brands. You've seen at least 2 more brands list in the auto space itself. And I think more of them will come. So I'd say that's the play-to-play consumption.
Deepak, your one key sector, segment, pocket, stock for which will likely give very good returns from this somewhat to the next for our viewers?
I feel domestic manufacturing. That's still underplayed in a large way.
But that's too large. That's too broad, Deepak. Anything narrower?
No, I won't go into
Okay.
stock level.
Sure,
But
sure,
I think this
sure.
is the broader theory. Yeah.
Okay, great. Thank you so much, Deepak, for joining us this afternoon. We'll let you go on that note.
Thank you
And
so
while
much.
we're talking somewhat to somewhat, viewers, let's also take a